Hello and welcome to our CLE on tax basics for the immigration practitioner. My name is Jennifer Chang. I am an immigration attorney. I'm also a member of AILA Santa Clara Valley. I'm a member of the CLE team. So today, as you all know, we are trying out our very first online webinar. So we're kind of working out the kinks, so please pardon any technical difficulties that might arise. I do want to point out a couple things. So the first thing is that, so Brian and I are actually in the same room. So the presenter and I are in the same room, and we're broadcasting live to each other. However, the feed that you guys are all watching is about 45 to 50 seconds delayed. So there is an option to ask questions here, and we would like to try to answer those questions in live time. But because the delay, if we've moved on, then we're going to save those questions for then. But we're going to try to keep those questions answered as they come in. So the way you ask questions is that if you look, I think it's right above here in your window. Oh wait, no, it's mirror. So I think it's right above here. You'll see, I think it's a few little boxes. So if you click on those boxes, you're going to see a Q&A feature. So if you hit that Q&A feature, you're going to be able to submit questions to us. Please ask your questions as they come up, and like I said, we'll try to answer them in live time. If not, we'll get to them at the end. The more questions you ask, the better.
Unless they're really hard. Just send an email.
Okay, so in addition to the logistics of this, I sent out a link for PowerPoint slides earlier through the Eventbrite. We actually took that down, and I'm going to, once Brian starts talking, I'm going to figure out how to send you all this link so that you can see we've created new, we made it a PDF. There we go. It should show up in your group chat. So we made that into a PDF, and then we're also sending out what he calls a resident flow chart, which he'll also be referring to during his presentation. Since the CLE is being offered free, what we're asking in return is that you help us, give us some feedback on how this went, and any suggestions you have for improvement. We're learning and we're trying new things, so please bear with us. We really value your feedback. So without further ado, I am introducing Mr. Brian Chong. Can you take your screen off screen share so people can see you?
Sure.
Oh, there you go. So this is Brian Chong. He is a CPA. He's been practicing for 11 years, and he works regularly with immigrants. So Brian's going to talk to us today about taxes.
Okay. Thanks, Jennifer. Let me...
Oh, you have to go back to screen share. No, you have to go back. Yeah, so screen share. Perfect.
Okay, am working?
Yeah.
Okay, so today's topic is going to be about U.S. taxation of resident and non-resident aliens. So here's the agenda for myself. I'm going to talk about resident versus non-resident alien, go over the two tests to see whether or not you're a resident, talk about U.S. sourced income, withholding requirements, the income taxation of resident and non-residents, what it means to be a dual status taxpayer, talk about the foreign bank account reporting requirements, some obvious mistakes on tax returns that you may see on your client's returns, and how to gift money. So like Jennifer was saying, I've been a CPA for over 10 years. I'm also an enrolled agent. I did my undergrad at UC Berkeley, and I got my master's in taxation at San Jose State. I've worked at Cisco, Marcus & Millichap. I've worked at Ernst & Young in their international tax department, and I currently have my own tax and financial planning practice. And my offices are in Santa Clara and Fremont. Okay, so although the immigration laws of the United States refer to aliens as undocumented aliens or non-immigrants and immigrants, the tax laws of aliens are very different. So we refer to, or the IRS refers to immigrants as residents or non-residents. And so the taxation of aliens really depends on their residency status. So I can see my chart here, in the bottom I have under immigrant, right, they're always classified as resident. And then for undocumented or non-immigrants, those that are on visas, they can either be non-resident or resident, depending on whether or not they pass the residency test. So, like I was saying, being an income tax resident is not the same as a legal resident. So I'm going to talk about what the differences are between a resident and non-resident for tax purposes. So you're a resident if you have a green card, okay, or if you pass the substantial presence test, which basically means how long have you been in the U.S. And the definition of a non-resident for tax purposes is to not be a resident. So it's pretty black and white. Okay. In terms of the green card test, all that means is you have a green card. So if you're a lawful permanent resident, then you're a resident for tax purposes, whether or not you live in the United States. Now the second part of that test, the substantial presence test, you would use this for someone that's either undocumented or on a visa to see whether or not they're a resident. And so the way this test works is you've got to first be physically present in the United States, and there's a series of tests that you use for this. So one is you've got to have lived in the United States for at least 31 days during the current year, and then 183 days during the past 3 years. And they have a formula for that, which means that for the current year, it's going to be all the days you lived there. For the prior year, it's going to be 1/3 of the days count towards this, the credit for this test. And then for 2 years prior, it's going to be 1/6 of the days.
So Brian, can you go back a slide?
Mm-hmm.
So if you were here present for 30 days in 2014, then we wouldn't even need to do this.
Right, you would be a non-resident.
Okay.
Okay. So let's see. Oh, so some things that don't count as days being in the United States are if you're commuting from, let's say, Mexico. And like as Jennifer pointed out, if you haven't even lived in the U.S. for 31 days during the current year, then you're automatically non-resident. Okay. But there is an exception. So even if you do meet the substantial presence test, let's say you've lived in the U.S. for the current year for most of the year. Okay. Even then, you may still consider yourself a non-resident if you can show that your tax home is in another country. So let's say you have your family, your business in another country, or you're just more closely tied to the other country, then you can argue that you are a non-resident. Okay. So let's run through an example of how you calculate the substantial presence test. So let's say you have a client that was physically present in the United States for 120 days in each of the years, right? This year and in the past 2 years. So you can see my calculation.
So this is assuming that it's still 2014?
Yeah, right, 2014. Right. So they lived in the U.S. 120 days in 2014, 120 days 2013, 12. So as you can see, you got to multiply it by some fractions, and you end up with a total of 180 days, which means it's less than 183 days, so they failed the presence test. And so later on, if you go to the PDF of the residency test, I actually create this flow chart which goes through how this all works. Okay. Should I pull that up now? Or?
I can pull it up. Oops.
Yeah,
are you going to go through it, or?
No, so it's pretty self-explanatory.
Okay.
All right. So now that we've established, the definition of resident versus non-resident, and the test that you've got to pass to call it resident, I want to talk about what is U.S. source income. Because generally speaking, if you are a resident, for tax purposes, you're treated the same way as if you are a U.S. citizen. So you get the same, you have to include your worldwide income and you get the same deductions. Okay. However, if you're classified as a non-resident, then the rules are different because now only your U.S. source income gets reported on your tax return. So U.S. source income, that's going to be, personal services performed in the U.S., like your job, self-employment income, business income, any interest and dividends. However, the rule for interest and dividends is that obviously if you're getting paid by a U.S. bank or a U.S. company, then that's going to be income. However, there are some exceptions. So if you have, let's say you're paid by a foreign partnership or corporation that's engaged in U.S. trade or business at any time during the year, then that's also going to be considered U.S. sourced income. And then there's another quirky rule regarding if you receive a dividend from a foreign corporation, but that foreign corporation, let's say 25% or more of their gross income for the past 3 years is connected to a U.S. trade or business, and effectively, portion of your foreign income is to be considered U.S. income. So I guess the bottom line, there's always, the general rule, and then there are some exceptions, which makes tax law really complicated and fun.
Which is why we're all immigration attorneys.
I guess so. So in terms of some other things that are U.S. sourced income, if you have rental properties located within the U.S., if you have, let's say you sell personal property and you're in the U.S., that's pretty self-explanatory. So that means if you have a rental property in another country, that's not going to be U.S. sourced income. Okay, now there's something called FDAP, which stands for Fixed, Determinable, Annual, and Periodical. And so the concept of FDAP income applies only to foreign persons earning income in the U.S. And essentially any income other than real or personal property, tax exempt income, that's going to be considered to be FDAP income. So the way the IRS defines FDAP income is essentially everything but, like real estate and tax exempt income. And so you could be taxed at a 30% flat rate if your income, if your client's income is not connected with a U.S. trade or business. Okay, and I guess the worry there, the fear there from the IRS is, well, they may not ever pay this tax if we don't collect it from them now at 30%. However, if that client's income is from earning from wages or from business, and they're going to be a resident, right? Then I guess IRS expects them to report their income on their tax return, and they would just have the same tax rates as a U.S. citizen. You have any questions so far? No?
Nope, no questions yet.
All right. So that flat 30% tax, that's to be withheld by the payer. Okay. So whoever's paying the income to the foreigner, the immigrant, they're responsible for withholding the money. However, let's say that client, their only business activity is trading stocks and securities and commodities, then there's no withholding. They don't pay any capital gains tax. Now, real estate is pretty hot, especially in the Bay Area. We have a lot of international investors. So Yeah, the rule there is when that foreign investor sells their real estate property, 10% of the sales price is to be withheld and remitted to the IRS. Okay, and so it's actually the job of the U.S. buyer to, figure out whether or not the seller of that, investment property is a foreigner, and then to withhold 10%, and then they've got to, remit the withholdings to the IRS within 20 days of the transaction, and then fill out a Form 80 to 88. Now, the big issue with this is if the buyer, that U.S. buyer, right, they fail to withhold money, then they can actually be liable for the tax that should have been withheld, plus penalties and interest. So it's really important when you are, let's say you have a client that's selling their property, make sure that, they tell the buyer that, hey, I'm a non-resident, so it should be withholding. And also, as you know, there are tax treaties. So the U.S. has tax treaties with most countries in the world, and these treaties, they dictate, how much tax that foreign person needs to pay, and who has a right to tax their income, and if there's ever any discrepancies, what the tiebreaker rules are. Okay, so I'm going to talk about the taxation of resident aliens. So like I said, they're taxed in the same manner as U.S. citizens, and they report their worldwide income, and they get the same deductions as the U.S. citizen. And they file a Form 1040, which is pretty standard. And then they've got to remember to, if they want to claim their spouse or their kids on their tax return, they've got to have either a Social Security number or a tax ID number.
So I have a question.
Mm-hmm.
You said that resident aliens are taxed the same way as U.S. citizens.
Right.
So that means that an undocumented person who meets the substantial presence test and would be considered a resident for tax purposes,
right,
would also be subject to worldwide taxation of their income and all that stuff.
Yes, that's right. Even if they're undocumented. So just because you're undocumented doesn't mean you're a non-resident versus resident. Right.
Wait, so even like our temporary workers that are here, if they're here if they're considered here long enough to be a resident, then they are going to be, they're also going to be subject to worldwide taxation?
Yes, that's right.
Okay.
So let's say you have someone here on a H-1B visa and they lived here for a year, then yeah.
Okay.
Do you have a question?
So we have a question. At the beginning, when you were talking about substantial presence tests, you were talking about 2014, 2013, etc. Are we talking about the most recent year for which we filed taxes, or the prior calendar year ending in December, or the past 365 days?
So I'm talking about if you're filing, say, like right now, right? I'm filing my client's 2014 return, so it would be for 2014, that calendar year ending in December 31st.
Okay, which is why the dates are for, you're looking at the presence of the calendar year that you're filing taxes for.
Right.
Okay.
Right.
I hope that answers your question, Jenny. If it doesn't, submit another question, please. And then we have another question from Roshni. For FDAP, does this refer to income? For FDAP, does this refer to income earned within the U.S.? The FDAP slide said foreign persons. Does that mean non-residents only? I'll go back to your FDAP slide.
Okay. So what the question is?
Does this refer to income earned within the U.S., or is it only for non-residents?
Yeah, so this is only for income earned within the U.S. and applies to non-residents.
So this would be like a student or a foreign worker that's here that does not meet the substantial presence test.
Yes.
I hope that answers your question, Roshni. I think we're going to come to this next question in a bit.
Well, about dependence?
Yes.
The answer...
So the question is, when can people claim dependents who live in other countries?
The answer is generally yes, you can.
But we're going to come to that in more detail as we continue on our presentation.
Yes.
Correct. Okay.
Okay. So previous slide we talked about how resident aliens get taxed. Now we're talking about non-resident aliens. And so generally speaking, they're only taxed on the U.S. sourced income. Okay. And they have to file, even if they're married, you gotta file marriage filing separately. That's one drawback of filing as a non-resident alien. Okay. And again, there's a 30% flat tax rate on their passive income, and they would file the return using form 1040-NR instead of the regular 1040. So I'm sure you guys want to know, when must a non-resident file? Well, generally speaking, they should usually file. So even if they didn't have any, income in the U.S., they should still file. However, of course, there are always exceptions. So the exception is they don't need to file if they made less than $4,000 from personal services. So let's say they had a job and they made less than $4,000, or they had let's say they had a student, they got some grant or scholarship money, okay, and it's less than 4,000, it's okay. This is kind of the same with U.S. residents too, right? Because that's your size of your standard deductions at $4,000. So if you make less than that, then you don't need to file. And so, well, the other reason why you'd want to file is to get back some of your taxes. So let's say, for whatever reason, you had some tax withheld, then you want to get a refund on that money, then that's another good reason to file. But generally speaking, you should just file. Alright. So now we're going to talk about dependents, which was someone's question earlier. So if you're a non-resident, right, you don't have a green card and you can't pass the substantial presence test, whether you're single or married, you can only claim yourself on the tax return, the 1040-NR. So even if you're married, you still have to file marriage filing separately. However, there are exceptions for this. So if you are a resident of Canada, Mexico, American Samoa, or the Northern Mariana Islands, you can claim exemption for your spouse and your kids, and there are some rules regarding that. Okay. And there's also exceptions for Korean and Indian non-residents. Like I said, there's always exception for every rule in the tax code. Okay. And also, so I know Jennifer was asking me earlier how the non-resident spouse gets treated. So let's say you're married and one person is either a U.S. citizen or a resident alien, and their spouse lives, outside the U.S. Right? So in that situation, that taxpayer, that U.S. citizen, they can treat their non-resident spouse as a U.S. resident and be able to file marriage filing jointly on the regular 1040 form, even though their spouse lives in Asia or Europe, whatever. Okay, so next topic is going to be about dual status taxpayer. And this is a situation where, let's say, the first year someone enters the country or the year that they leave, that they're both resident and non-resident. let's say, you know, part of the year they're non-resident. Let's say the first year they come in, they're non-resident, right, at the beginning, but towards the end of the year, because they've been here for, over 183 days during that year, they become a resident. So during those years where they switch from non-resident to resident or vice versa, you're considered a dual taxpayer. And so in that situation, you actually have to file both the 1040 and the 1040 NRs. You have to file both forms, and then on top of the form, you just write, dual status taxpayer. Okay. And so let's say that during the period of time that you're considered a non-resident, then only your U.S. source income would be taxed, and then on your regular 1040, that's a time that you are considered a resident, and then during those months, your worldwide income would get taxed.
So this is, we had a conversation about when your status matters, and the conclusion we came to before was your status matters at the end of the calendar year. So that's not true.
No.
Okay.
So you can be both during the same year.
Okay. All right. Cool.
Okay. All right. So, as you all know, there's a requirement by the IRS that if you have assets overseas, that you got to report them on your tax return. It's not taxable. It's just a reporting requirement because the IRS wants to know what everyone's doing and make sure that they get all their tax money. So there's something called the Foreign Bank Account Report. Used to be called the Form TDF 90-221. And what that requirement says is that if the aggregate value of all your foreign, bank accounts, stock accounts is $10,000 at any time during the year, then you got to file this form, and it's due June 30th. Okay. And there's also a significant penalty if you don't file that form. And then same thing with there's another thing called the Foreign Account Tax Compliance Act, FACTA. And again, this form you've got to report any foreign financial assets, and there are, of course, significant penalties for not reporting. And so the way this works is there are a lot of countries that have entered into agreements with the U.S., and so they will tell the U.S. when they have U.S. citizens' money in their bank account. So then this was a big deal recently, just because, the Swiss banks, and there's always been secretive, but now they're releasing names of their, the U.S. account holders. Mexico joined in on this too. Most of the countries in the world are actually helping the U.S. in terms of keeping track of this. Even China.
So this applies to both residents and non-residents?
Yeah, this applies to both. Right. So I have a lot of clients that are from Korea, since I'm Korean, and also from India, because there's a lot of engineers here in the Bay Area from India. Mm-hmm. And so I always make sure to ask them about this, because they probably won't get taxed on anything because they'll have a little bit of interest income in a foreign bank account, right? Not a big deal. But if they don't report it, the penalty could be like $25,000.
I see. Just
for not reporting it.
I see.
So make sure you tell your clients to tell their CPA that they have foreign accounts. So foreign real estate, that does not count. I get that asked a lot. So foreign real estate doesn't count. You only report that, just your cash, your savings account, your stock accounts. Okay. So I just wanted to point out some mistakes that you should be able to spot on your client's tax return, because I understand that
so this came up in the context of when we submit a affidavit of support, for instance, we have to submit the client's tax returns with it. So I asked Brian, what are kind of obvious mistakes that we can be aware of so that we know if we're sending something to the government that is clearly wrong.
All right.
So these are some things that he's come up with that are clearly wrong.
Yes. So obviously, claiming fake children, fake spouse, there's no social security number. right? That's a red flag. Or social number and the name doesn't match. I guess the way you can do that is, what I do is I ask people for a copy of their social security card. So I can verify that their legal name and social security number match what I'm going to put on the tax return.
Okay.
Because I don't want it to bounce back. So when you e-file a return, if the numbers don't match, they'll actually tell you within a couple of days. IRS will tell you if there's no match there. Some other things people do, they have, let's say, huge itemized deductions. They make a little bit of money, but they claim that they donate tens of thousands of dollars to charities. Or maybe they have a fake business loss under Schedule C, which is always a bad idea because you'll get audited for that. Yeah, Schedule C gets audited a lot more often than any of the other forms because it's so easy to just claim a loss. And then partnership loss. So this would be if you had a business that's a partnership and then or an S corp, and that business would file their own tax return, and then the shareholder or the partner, they would get a Schedule K1, right, reporting their loss, and then that loss gets reported on that individual's tax return on their Schedule E. So that's another place where people can enter a fake business loss. But the chance of getting audited there is actually a lot lower than the Schedule C.
Okay, so this question is related to the mistakes in tax returns. So Jessica is asking, so can we address when resident aliens may claim a dependent who lives abroad? Many longtime permanent resident clients claim children and spouses or other relatives living in other countries. Is this allowed?
Yeah, so that depends. Just like every other tax answer, it depends on the situation. So you can claim your children, your spouse living abroad as long as you're actually the one, supporting them. Right? So if they have relatives there that are actually paying for all their food and education and rent and all that, then no, you can't claim them. But if the resident here in the U.S. is actually sending money back home and paying for their family's expenses, then you can.
Is there is it the majority of expenses?
Majority, yes.
Okay, all right.
You'll be supporting the majority.
So in that case,
How the Irish would know, I don't know.
So in that case, you would be listing someone that doesn't necessarily have a social security number.
No, you have to get them right. They don't have social, but so you have to apply for a ITIN.
Oh, so even if they're not in the U.S., they can get an ITIN.
You can get an ITIN.
Okay, so the right way to do it is to get an ITIN and then report that on your taxes.
Right, because if there's no ID number and you just have a name, you cannot get a deduction for them.
Okay.
It's not going to work.
Okay. So we have a question from Irma. Are there limits to the kinds of relatives you can claim as dependents, like nieces, grandfathers, estranged
No, you
children?
can claim anyone that you support.
So you don't have to be related to them?
Actually, you don't even have to be related to them. So I'll tell you a story about the tax court case that just happened last year. So there was a situation where you had this guy, and he was married, but one of his buddies, his college, buddy, one of his best friends, was kind of hard on his luck and was unemployed, and so this guy, his friend, actually crashed at his apartment. Right, it started off, temporary, but the guy, his friend, was just lazy and never got a job, and he ended up living at the in the guy's living room for about 2 years, and his wife was just fed up with it, left. It's either him or me, honey, and she left. And this taxpayer actually claimed his friend as a dependent on his tax return because he was really supporting everything. He bought him food, gave him a place to live. His friend wasn't working, so he didn't have a way to support himself. And of course, the IRS, challenged this, and they lost. The taxpayer won because he was supporting the guy.
Wow. Mm-hmm.
Okay. So I'm sure you guys have a lot of clients that send money back home, right? Or vice versa. Maybe they receive money from abroad. So I just want to go over the tax implications of those two scenarios. So let's say you receive money from a foreign person. Okay. So if that happens, congratulations. So that money, you know, the U.S. person, right? They need to report those gifts on the form 3520. However, that gift is not subject to income tax. It's a gift. Now, on the flip side, if you're sending money overseas to your relatives, you can transfer up to $14,000 per person without paying the gift tax. Okay. So let's say I send $14,000 to my aunt in Korea, my uncle in Korea, my cousin, whatever. That's $14,000 per person that I'm sending it to. So direct, I can send like hundreds of $1,000s, right? And not have to pay any gift tax. And then the other rule is if you're sending money to my kids, there's no limit. I could send, if I had a kid living, overseas, I could send them $1 million and it's fine. Yeah, I think that's my last slide.
Let's take the slide down so they can see us.
Okay.
Okay, so we have. So we have another question from Melinda. It says, I might have missed it, but if you pay the majority of expenses for your relatives living abroad, they don't have social security numbers, can you claim them as a dependent?
No, you would have to get a ITIN number. You have to apply for that.
Oh, you're still.
So yeah, without a social security number or a ITIN, you can't claim them on the tax return. Okay. And getting ITIN is really easy. You just fill out a form.
Yeah. Okay. So yeah, so the answer is that you can claim it. You just have to have them go get an ITIN online.
Yes.
So I have a question. So basically, we have the distinction between residents and non-residents. So at what point should we be telling our clients to seek out a CPA? Because it sounds like pretty much everyone should be filing taxes.
Yeah.
So should my students that are here on a student visa, I should be telling them to see a CPA once they get here, or?
Yeah, I would, just to be safe.
Okay, and is that also true for like visitors? If there's someone that's visiting here for extended period of time?
They're going to be here for more than 183 days.
Okay.
Talk to a CPA.
Okay.
To make sure.
So I want to clarify, when I'm doing tax planning when I am working with a client who is applying for a green card and we need to do, I want to advise them that they should go consult a CPA so that they can do their proper planning to minimize their tax consequences. At what point should I be advising them to do that?
It's kind of like, what point should I talk to an attorney? Of course, the earlier the better. Especially, before tax returns are due, right, in April. So, it's not too late. Like right now, it's February. So if you have a client that's been in the U.S. for more than 6 months, and tell them to talk to a CPA, see whether or not they need to file a return.
Okay, so I had this situation where I have a client that I have already submitted 485 for, so she's applying for a green card. Okay. And so she came in last February as a tourist, and before so I had advised her to seek out a CPA, but it sounds like it might have been too late when I told her, because this was, I think this was like in November or so. And so any tax planning that she's doing now, is it?
So she arrived February of last year?
Yeah, she arrived February of last year, and I was under the impression that we just need to have this taken care of before she actually gets her green card, and is subject to worldwide taxation, but it sounds like that's not true.
So, well, if she came in February of last year, then she's been here for, well, 2014, she's here for like 10 months, right? So
yeah.
she'd probably file a tax return
Okay.
So it's not too late to file tax return.
Well, it's not too late, but in terms of like tax planning, like her assets that she has abroad, like real estate or stocks, in terms of being taxed on the income from those, it sounds like it might be too late.
Oh, I see. Yeah, you got a good point there. I mean, if she sold her stocks, yeah, but then it depends on when she sold it to. 'Cause- So 2014, since she entered the country, then she would be a dual status taxpayer, right?
Okay.
So let's say 6 months after she came in, February, it was August, right? So maybe the stuff she sold before August,
Yeah.
right? When those stocks that she sold or the rent she collected,
Yeah.
not taxable, right? Because it's outside the U.S.
Right.
The stuff after August through December, that would be taxable.
Okay. So the lesson is that we really need to pay attention to when our clients are here and not necessarily what immigration status they have.
Right, right. Because the way the IRS looks at it, it's different from the way immigration attorneys and everyone else looks at it.
Okay. And Irma, I just saw that you had a question, but it disappeared. So I'm not sure if you intended to delete that or if that accidentally got deleted. But please resubmit that if that was not unintentional. Okay, so another question for you: what happens when you give up your green card? If someone wants to move back, like tax-wise, if someone wants to give up their green card and move back to, let's say, Japan.
Okay. Well, then you got to fill out a form, and then you have to also not swear, but you got to basically agree that you're not gonna have U.S. income for a while.
Okay.
So they want to make sure that you're not leaving the country just to avoid paying taxes.
Okay.
So I think there's like a 5-year look back period. So after you move out, the next 5 years, if you're still earning U.S. income, then you better report that.
Okay, so that means so a person moves back to Japan, and for the next 5 years, they're still obligated to file taxes, or?
It could be if they have income.
Okay. All right. So they should continue to work with their CPA.
Yeah, they should.
Okay.
Consult with them.
Okay. And then, so we have a question from Jenny. I have a permanent resident client who has many assets here and abroad. She's going to naturalize. It sounds, which is becoming U.S. citizen. It sounds like her tax liability will be the same whether or not she becomes a citizen. Is that true?
Yeah, that's right. Because whether she's permanent resident or a U.S. citizen, the tax is going to be the same. Okay. So that's not going to change anything.
So really, the distinction even between being a non-immigrant and like a permanent resident, or the distinction is really just whether they're a resident for tax purposes versus non-resident?
Right. That's one that matters.
Okay. Oops.
Yeah. So like the first slide I had that showed those colorful boxes.
Mm-hmm.
Yeah, that's how you would categorize them.
Okay, so Irma has a question. For people who didn't file taxes for a number of years and they don't have W-2s because they either lost it or were paid with cash, what do you recommend they provide to help recreate that income?
Wow, so bank statements, that'd be a start. I mean, I imagine they would deposit the money, or maybe if they cash it out, they would have to have some kind of record of how much money they made. So it's going to come from the client themselves, their bank statements. If they have, if they remember what companies they work for, they can go ask them for a copy of their old W-2. And also the IRS, because they receive a copy of all those tax documents, they should have a copy of the W-2. Mm-hmm. And quite frankly, if someone hasn't paid taxes in a long time, and the company they work for has been filing the 1099s or W-2s, the IRS, they're going to find out, and they'll send a letter to the client asking them, to file their old returns and pay back taxes and penalties and interest.
Okay.
Yeah. Oh, and then I'll talk about the statute of limitations. So normally, when you file a return, there's a 7-year statute of limitations when the IRS can audit you, right? if you file, let's say, April of this year, you know, it's good for the statute's open for another 7 years, so they can go back and audit you. However, if you never filed your return, then the statute never begins, so it's indefinite.
Mm. So they can always make you go back in, file, and pay your taxes. Okay.
And a lot of times the penalty and interest is like more than the taxes. Seriously.
Okay, so we've got another question from Jenny. For that client, the one that about the naturalization question. So for that client, once she becomes a citizen, if she moves back to her home country, how is her tax liability going to be different as a U.S. citizen versus as a permanent resident?
It would be the same, because again, whether you're a U.S. citizen or a permanent resident, you're called a resident for tax purposes, and the tax laws are similar. So
and
no matter where you live.
And sorry, that was exactly what I was just going to clarify. Is that for residents and U.S. citizens, being a resident for tax purposes has absolutely is not at all linked to whether you're physically present in the U.S.
That's right. If you have a green card or U.S. citizen, or you're a U.S. citizen, doesn't matter where you live, you're supposed to pay tax on your worldwide income. And so, actually, I want to talk a little bit about the foreign tax credit. So sometimes people know, I live abroad, I work abroad, I'm a U.S. citizen, am I going to get double taxed? And the short answer is no. So what happens is you pay tax. Let's say you work in Germany, right? So you pay taxes to the German government, and you file a tax return there. And you also have to file your U.S. tax return. However, you get a tax credit on all those taxes you pay to the German government. Okay. Now, so the good news is, the IRS, they give you a credit for a tax you already paid. You're not double paying. The bad news is, the U.S. actually has one of the highest tax rates in the world. So you're going to be paying, U.S. taxes, which are going to be higher than any other countries.
Okay.
So somehow, IRS, they would pay their money.
Okay, so for those of you that are on the you're all on our broadcast, but I believe above your screen where the 4 boxes were for the Q&A, you should also see a chat option. So in the chat option, I've included the links to the PDF version of our PowerPoint presentation, as well as the resident flowchart that Brian has prepared. And then I also just included the link to the evaluation for the CLE. If you want CLE credit, you need to sign in through that form, and we'd appreciate any feedback you have on how this on this broadcast, just so that we can know how to improve in the future. Let's see, do we have more questions? Not yet. Okay. Any other points that you'd like to make? We still have about 10 minutes left. Please submit your questions.
I love working with attorneys. I have a large network of attorneys. So if you guys ever want to grab lunch or coffee, next week up to about that time, or end of April, May, let me know, and I'd be glad to meet with you and network with you.
Mm-hmm. Do you want to put up that slide with your? Oh, actually, I can do it. I'll put up the slide with your contact information. So I guess if no one has any other questions, then we can conclude. But I guess we'll hang out a little. Oh, we'll hang out a little bit. Oh, I don't see a chat option. Where is the chat box? That's a great question. I actually don't know the answer to that because my view is different from yours. But from what I understand, there's the boxes where you found the Q&A. There should also be the chat. Oh, you know what? Maybe not. When we conclude, I'm gonna send another email out through the Eventbrite, and then we will. I'll have the links to all the materials as well as the evaluation. So if you could please fill that out, we'd really appreciate it. The evaluation is actually going to turn off the at about 1:30 today. So if you could please fill that out at the conclusion of this, we'd really appreciate it. And then I'll be emailing CLE certificates to people who complete that. So I have another, so we have several questions about that. And then, okay, so we have a question from Patrick. I understand that an undocumented person who works for, I understand an undocumented person who works for cash only is required to file a tax return. Such a person has no W-2 and no 1099. How does such a person file a tax return?
They would just have to recreate their income. You know, I mean, they know how many hours they work, how much money they make, so they would have to just put it on a spreadsheet and figure it out.
Okay, so you don't need anything formal to show, like no self-made W-2 or anything. You just have.
Yeah, you can't self-make a W-2.
Okay, but there's no like form or anything that you have to do that goes with that. You just have to document your own income.
Yeah.
Okay. All right. Let's see. Everyone's asking where. Sorry, everyone's asking where the chat option is. I'm sorry. I think I made a mistake. I don't think you guys see the chat option. I think that's me and Brian. But I said, as I mentioned before, I will send out the links to all that stuff from the Eventbrite. So if you could please take a look at that, the survey in order to get CLE credits, that is going to close at about 1:30 today. So if you could please take the time to fill that out between 1 and 1:30, we'd really appreciate it.
Okay.
So let me clear all these questions about the chat box. Sorry, technical difficulties. It's a free CLE.
But hopefully it was a good one.
Yes. So yeah, so please do keep in mind that if you wanted CLE credits for this, you do have to complete the CLE evaluation, which is the survey that I'm going to send out. Okay, so there are so many questions about the documents. I'm sorry about that. We will send that out afterwards. Okay, so we have a question from Melinda Zhang. She says, can we email Brian later to ask questions about these things?
Of course.
Okay, so let's see if we can figure out how to pull.
bchong12@gmail.com. And Jennifer's going to pull up that slide.
Do you see that? Okay. Oops.
And I'm located in Santa Clara and Fremont.
Okay. Okay, so we have a specific question. I think this is regarding CLE credit that someone else is sitting in. With two people are watching from the same feed. That's totally fine. We're just asking that if you want CLE credits, that you need to fill out the link to for the CLE evaluation, and that in order to get credits, you must complete the evaluation by 1:30 today. So that's going to go live at 1 o'clock. As soon as we hang up here, I will send out an email through the Eventbrite about that.
Okay. Let's see here.
Okay. Yeah, only you can see it. Sorry, those are our technical difficulties. All right, so if there are no other... Oh, okay, so we have one more question from Patricia. In your experience, where one spouse is undocumented and one is a U.S. citizen, is it recommended that they always file married filing jointly? What happens if each filed single?
Well, let's see. If they're married, they're supposed to file married filing jointly. They can't file single. I guess the equivalent of filing single would be married filing separately, which is actually a worst case because you end up paying more taxes that way. So the undocumented spouse, like I said, they would, for tax purposes, they are a resident alien. They live in the U.S., right? Because yeah. So can you go back to the question?
Yeah.
Okay.
So
let me ask: if the undocumented immigrant spouse if they work or not. So if they don't work, they have no income, then it's definitely better to file marriage filing jointly over marriage filing separately. The reason is because the way the tax code works, or the way the tax rate works, is like this. Let's say you're single, right? And the first $50,000 of income is like taxed at 10%. Then from 50 to 100 is taxed at 25%. Now, if you're married, that the amount of income you need to earn before you get hit, say 25% tax rate is higher. It's not twice as much. It's like 1.5 as much. So let's say if you make $150,000, then you're in the 25 tax bracket. If you're married, compared to if it would have been at 100,000 if you were single. So the benefit is if your spouse doesn't work, then definitely file marriage filing jointly. And there's also something called the marriage penalty, which happens when you have two people that both have good incomes, they're married, and they actually pay more tax than they would have if they had never got married, if they had stayed single. Because like I was saying, maybe if you're single, the first 100,000 is taxed at like 25%, but if you're married, maybe the first 150,000 you're at 25% tax bracket. So that's what's called the marriage penalty.
So, okay, so if they are married, but then they accidentally filed single, what would you recommend they do? Should they go and amend their tax returns, or?
They should, yeah.
Okay.
And then the other problem with amending a return is also a red flag. You're basically making the IRS do that stuff.
Okay.
Tax return. There's also the chance you get audited too.
So is it better to admit or wait for them to catch you?
I would run them. Talk to your tax advisor.
Your tax attorney. Yeah.
Have them run the numbers for you, see if it's beneficial or not to amend it.
Okay.
So you gotta weigh the pros and cons plus the cost of paying that CPA.
So here's a related question: is there a statute of limitations on how late you can amend tax returns that had mistakes?
Is there a statute of limitation on that? That I'm not certain.
Okay.
I'm not sure. It could be up to 7 years.
Okay.
I'd have to look into that.
Okay. So Jessica, if you wanted a concrete answer on that, I'd encourage you to reach out to Brian and have him do the research for you. And his contact information is in the PowerPoint slides that I will send out at the conclusion of this.
Okay, that reminds me. So I also do, complimentary consultations, first half hour with your clients. So no charge for that.
That's great. Do you offer that to everyone, or should they mention?
Just for you guys.
So should they mention that they know you through Ayla?
Yeah. Okay. Tell them, a client call me and say, oh, I'm so-and-so attorney, refer me to you.
Okay,
and
great.
I sit down and talk to them.
Thank you. And we have one last question from Irma. When is a head of household filing appropriate?
So head of household would be if you were like, like a single mom, right? Then that's when you use head of household. So when you're single and you have dependents.
Oh, okay. So you have to be single for that.
Yeah, if you're married, you'd file marriage separately or jointly.
Okay. Okay, great. All right, well, that is our 1 hour, and I think we've gotten through all the questions. So thank you all very much for tuning in and bearing with us as we work out the kinks in this. And thank you to Brian for coming to present with us.
Thank you, Jennifer, and Henrik for hosting.
All right, so again, I'm going to send out the links right now through the Eventbrite. So if you could check your email and please fill out the survey if you want to receive CLE credits by 1:30 today. Thanks to everyone for watching. See you next time.